because I'm so sure of silver going up a fairly large way from here. When the media is saying bust and crash, oh, be worried, that's bullish. And I'll tell you what's bearish. It's when they all go quiet, when it goes like that. And, say, for example, silver went through $60 in the next few days. If people weren't saying it's gone too far, it's going to crash, silver's, never going to go up, oh, it's terrible, that's bullish. It's when it goes boom and you don't hear anything. It goes silent. Then you want to be worried.
Silver prices have hit the record levels, which have been supported by the constant supply chain problems as well as the renewed expectations that the Federal Reserve will reduce its interest rates next month to provide more momentum to the rise in gold prices, as the prices are currently trading at a 2-week high. The tightening supply backdrop is also contributing to the upswing, and inventories in warehouses of Shanghai Futures Exchange have dropped to their lowest since 2015, reports indicate. The Silver Institute predicts that 2025 is the 5th year on the row of structural shortage of supply, with the world's production through mining and recycling still struggling to meet the escalating demand in solar, electronic, and investment sectors. The growing demand on silver is pushing the gray metal ahead of gold. Now the level in the gold/silver ratio stands at 74.75 points, the lowest since early May 2024. Meanwhile, the silver rising higher above $56 is flashing analysts to the 2010 to 2011 cycle, where the silver stood still at the middle and then soared to $50. Clem, a well-known financial journalist, is of the opinion that the same trend is repeated once again. The only difference is that this time around the prices are more expensive, and he is of the opinion that this time silver would run to about $80. In his view, media panic about silver is typically a good signal, and silent or high-level excitement is a bad signal. Before we begin, make sure to subscribe and click the bell icon to stay up to date with all our latest videos.
When the media is saying bust and crash, oh, be worried, that's bullish. And I'll tell you what's bearish. It's when they all go quiet, when it goes like that. And, say, for example, silver went through $60 in the next few days. If people weren't saying it's gone too far, it's going to crash, silver's, never going to go up, oh, it's terrible, that's bullish. It's when it goes boom and you don't hear anything. It goes silent. Then you want to be worried. So, silence in a boom, well, or everybody going Hosanna, that's the other thing. When it was going, it's going to go to $200, $500, $1,000 an ounce, then you want to be thinking about heading for the exit. But when everybody's saying, oh, no, oh, no, it's bad, oh, it's going to go down, oh, it's ridiculous, that's bullish. It's bearish when it goes quiet and when everybody's saying it's going to double from here. It's going to be $1 million by Wednesday. That's when you want to get out. In random behaviors, when you make a decision or when something happens that makes you think it might have finished, it could have finished, but it might be halfway. So one way, and I can't remember the name, but some Austrian mathematician, if you write a book, your chances of writing 2 books are 50-50. If you write 2 books, your chances of writing 4 books is 50-50. If you write 4 books, the chances of writing 8 books is 50-50. So this is why you get, was it Liszt? I can't remember. He wrote, 200 symphonies. So the more you do, the more you'll do. That is the rule. And it's the same with any random, semi-random process like that. So if you're at 1,000, you go to 2,000, the chances of going to 4,000 is 50-50. And when you get to 4,000, the chances to go to 8,000 are 50-50. Well, we're at that 4,000 in gold, and the chances of going to 8,000 is 50-50. So what you're looking for is suddenly, because, okay, I've got this asset, silver, and everybody goes, yeah, who cares? And suddenly something happens, and it goes, bang, and it stops. Now, that's called a repricing. It's repriced. There was a reason for repricing. I don't know, and Penguins suddenly decided they needed to buy lots of silver, and it repriced, bang, and it stopped. Okay, now it's got equilibrium, and so it goes bang, and it goes zzz. Now the chances are 50-50 that it's going to go as far again, and you could say 50-50 that it'll go back down. And you think, well, that's no help to me. If it's 50-50 up or 50-50 down, I'll pick this direction, and half the time I'd be wrong, half the time I'd be right. But that isn't actually the trick. The trick is When it breaks away from its equilibrium, the penguins want more silver, it goes out of that equilibrium, and then the chances are very high that it's going to go as far again. So basically, you get a signal of a big move. So equilibrium, bang, it breaks out. That's the signal is going to have a big move. And you know, because of the 50-50 rule, it's either going to go a long way that way or a long way that way. So when it does it, you can jump on it. So for me, as somebody with a position of silver rather exciting, I'll sit there and I'll expect it to break on up and then double. If it will break on down, I would go, oh, hold on a minute, I wasn't expecting that. What happened? What did the penguins not want their silver anymore? And I'll reevaluate. And if I'm certain I'm right, I'll be holding on, and then maybe I'll prove to be right. And if I suddenly realize that maybe it's done its thing, I'd get out and keep most of my profit. So the equilibrium breakout one way or the other is a signal of a big move. And that big move is something that you can make the most out of, particularly if you're watching that asset and you know in your mind which way it's going to go. It will give you a signal whether you're right in your assumption or wrong. And that will give you room to either take your profit or sit there and get the next big one.
The U.S. financial system has been stealing silently into the next series of liquidity assistance in the past few days. The Fed has relaxed its quantitative tightening, increased its repo purchases, and forced tens of billions of dollars back into the markets. Meanwhile, banks are increasingly relying on short-term Federal Reserve loans, and the heavy issue of Treasury bills is further tightening money markets even further. And each time we have the same occurrence, U.S. stocks begin to pick up, and so do hard assets. That is where silver comes to the scene. Clem Chambers believes that money does not disappear, it only changes location. When a large amount of money is injected into the system by the Fed, much of the money ends up in financial assets, particularly commodities such as silver. And silver is the most likely to shine when a new cash flow is poured into the market. Clem says this isn't random. Silver is responding directly to the activity of Federal. Greater liquidity implies greater demand of real scarce assets, and silver is among the biggest beneficiaries. Now let's redirect our attention to the speaker again.
The US government pumps money into the economy to make sure there's enough money, and it kind of guides itself by the value of the S&P. But when you pump money in, when you print money, if you print it in a certain way, like they've been doing now for quite a long time, it goes straight into assets, and it goes straight into financial assets. And, you know, the government, US government was on pause. So the money flow was on pause, and the cash was being, you know, basically dammed up in the Treasury. And the Fed was going into reverse with QT. So there's a kind of a big clunky machine changing the way it's managing the money supply, and they all crossed over, and there was a big liquidity squeeze. As I was saying on a lot of podcasts, you know, liquidity squeeze is just a pinch in the money supply. And when there's not enough money to go around and the money's not flowing, assets go down. It's like, you know, I better sell my Microsoft. I've got to, you know, pay the balloon payment on my car or whatever. I can't make the mortgage payment. I'm going to sell my gold Rolex down the pawn shop. It's the same thing with all assets. And so when the money stops flowing, down go assets. And when the money starts flowing again, up go assets. So you had this pinch point in liquidity, money supply, and assets go, Well, actually, the investors do that. And the prices go wobble, wobble, wobble. When everyone starts to go, I'm panicking now. Oh, my gosh, it's the end. I knew it was coming. And then they pull the lever with the money supply and up it goes again. And I think I saw something in passing, and this number's going to be wrong, and you can find it out yourself, that they pumped in $110 billion in the last few days, or last 10 days or so. And, you know, that will lift your assets. So, you know, a money supply, a liquidity crunch, down goes the assets. They pull the lever, up they go. And that you're seeing the other side of that. And I think you'll see a really strong run on assets up to Christmas now, which will be ho, 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 very good. You'll be sat there like a beach whale for the last 15, 20 years, missing the biggest bull run in history. So the thing to be is, you know, aggressive, not silly aggressive, not over leverage aggressive, but looking for opportunities in the market to then back. So invest in opportunities and look for those opportunities, and don't listen to the doomsters. And, gold's been an opportunity, silver's been an opportunity, copper's going to be a massive opportunity, oil's going to be a big opportunity going forward at some point. And you stake them out and you go, well, when this happens, I'm going to buy that thing. And then this happens and then you buy that thing. You don't have to be in there now. You don't have to be scared. You just have to be methodical. And, you've got to be, as I say in my favorite sport, cricket, on the front foot. Or as they were saying in Silicon Valley, you got to lean in rather than lean back. And, that is the trick. And we've seen that with this recent liquidity squeeze and with the government shutdown, that a lot of people have been terrified by it, and then it goes away again. Now, that's not to say if you're in a bubble and you think you're in a bubble, you have to sit there and hope it carries on going. You just have to be leaning in. And if you look at that chart, you can get a sense of proportion. That little bobble is, oh, what's going on? Nobody knows. Fred did this, Jim did that. This strange reason that nobody agrees with. You just sit pat. If your president comes out and says, we're going to invade Greenland, then maybe you do want to get out of the market. But, it has to be something pretty cataclysmic to turn around this long-term trend we've been on now for almost ever. I mean, the credit crunch was that thing. The whole of US housing nearly went down the pan. Yeah, well, that's a reason to get out of the market. And yes, at the beginning of the year, what Trump was saying about tariffs was a reason to get out of the market. And, if he had kept to what he said he had done or was going to do at the beginning there would have been a big crash. But if you take the gaps between moments where you really have to think carefully about whether you want to be in, you go Trump, COVID, credit crunch. Well, there's years between those things. And yes, the NASDAQ will go into a bubble, and yes, it will probably crash. But you don't want to get out of a bubble at the beginning of the bubble. You want to get out of it near the end. And that's maybe 2 years away now. So, it's good to be leaning into this stuff rather than sat there going, oh, I'm going to sit on my hands. I'm scared now. It's good not to be scared. It's good to be careful.
Silver has always been the shadow of gold, but as of late this little metal is also coming out of the shadows. As gold snatches the headlines, silver is recording better percentage returns and increasing in significance, particularly due to its industrial applications in industries such as solar energy. The bull market in gold has been widely discussed and the fundamentals of the 3-year run-up of gold, but long-time silver had been given little attention. Silver is now finishing the week at a record high of more than $56 an ounce, and 97% higher than it was in January. Compared to gold, the latter is probing significant opposition at $4,200, and it has gained almost 61% in the course of the year. So what is becoming of silver? We encourage you to comment your thoughts below. If you found this helpful, leave a like and subscribe to join our community. Thanks for being here.